morning and welcome. I am Mackenzie Babb, External Affairs Director for the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm pleased to welcome you to Will the Fed Overshoot, the latest in our series of monthly press briefings exploring the state of our economy. This and future briefings on the topic will coincide with the release of the Labor Department's monthly jobs report, which typically falls on the first Friday of the month. Today's conversation will be led by Kenan Institute Executive Director Greg Brown. I'll be handing things over to Professor Brown here momentarily, but before I do that, I'd like to provide a bit of a roadmap for what to expect for how today's conversation will go. For the next 15 minutes or so, Professor Brown will provide his insight and analysis regarding this morning's report. We will then spend the second half of our conversation together fielding your questions. I welcome you to submit those anytime using the Q&A function at the bottom of your screen. So that we may prioritize questions from the press, please plan to include your name, title, and organization with your submission. For those who may be joining us by phone, you are welcome to email your questions to me. My email address is mackenzie_babb@kenan-flagler.unc.edu. We will aim to get to as many of your questions as we can before we wrap at 9:30 Eastern. And with that, it's my pleasure to hand things over to my friend and colleague, Professor Brown.
Thanks, Kenzie. Good morning, everyone. Interesting report we got this morning, and I'm going to walk through kind of what the headline numbers are and then a little bit of commentary around it, and then dive into sort of the topic for today, which is, what is the Fed going to think of this? And in particular, is the Fed ending up in a position where they might be forced into a situation of overdoing it on rates? So take this morning's numbers and put those in the context around what we think might be happening with monetary policy. So I'm gonna go ahead and share my screen here so we can look at some data together. So just hitting the headlines here. So basically the change in non-farm payrolls number came out right as expected, 315 versus the expected 300. The numbers that were for July and June were revised down, but almost all that revision was down about 100,000. The revised numbers, almost all that was in June though. So that really, really strong July number that we saw is basically unchanged. A little bit stronger numbers in manufacturing, but basically in line with expectations. Our average hourly earnings were up 0.3% in the month. That's just slightly less than was expected, 0.4%, really within the margin of error there. And if we look on a year-over-year basis, we're still seeing pretty strong growth in average hourly earnings. Average weekly hours also softened just a little bit, but again, this is sort of within the margin of error of the survey that's done. I don't think we should read too much into that. Maybe the biggest surprise in terms of the headline numbers was the unemployment rate ticked up to 3.7%. But this is an interesting increase in the unemployment rate, because actually the household survey, which is where the unemployment rate comes from, it actually showed even larger increase in employment. But the number of people looking for jobs that entered the labor force was even bigger. Consequently, the unemployment rate ticked up. So I was sort of watching the bond market when the release came out, and there was sort of a big rally, I think, because people were like, oh, this is some sign of a softening economy with the unemployment rate ticking up a couple tenths. But when they dug into it a little bit more, pretty quickly, things reversed, and we saw a bit of a sell-off in the bond market. If we look at labor force participation rate, it's gone up 62.4%. This is, of course, a huge issue. If there is going to be something like a soft landing or a situation where the Fed is able to thread that needle, it's going to come from more people joining the labor force and a higher labor force participation rate. So seeing that bump up a couple tenths is probably also an encouraging sign for the Fed. So just to put this in a little bit, more of a recent historical context, we continue to see just really, really strong employment growth. So these numbers that on average have been, 300,000-400,000 for most of this year, those are really strong numbers by historical standards. And as you can tell from anecdotally, you can tell by looking at these reports, the labor market is really, really strong. So, here the blue bars, you can see these are the monthly changes in payrolls. So they've been 300,000 to 500,000 each month for the last 6 months. Those are just really strong numbers. And even though the average is trending down a little bit, that 3-month average of almost 400,000 is again very, very strong. So if we look at sort of how things are performing relative to the peak, we saw last month that we finally regained the number of total jobs in the economy that we had prior to the pandemic, and we continue to tick up a little bit on that. But effectively, in terms of the total number of people working in the U.S. economy, we're kind of just now back to where we were before the pandemic struck. There is heterogeneity in these numbers, though. It's not like every sector has recovered completely. And in particular, if we take one sector that is kind of important in terms of what's happening in the economy right now, transitioning back to a more normal economy, leisure and hospitality is still a million jobs short of where it was pre-COVID. And of course, we know that these are particularly challenging jobs to fill because they tend to be lower wage jobs, and there's just so much competition for employment right now that it's hard to know whether this is a supply or a demand side. It's probably a supply side issue in terms of not being able to find employees to staff positions. Unemployment rate, again, even though it ticked up a couple tenths of a percent, effectively, at a all-time low. It's unlikely to get much lower than it is right now, just because of sort of the normal frictions in labor markets. And again, I don't think we should read too much into the 0.2 uptick. So let's go back to this question about the labor force. Excuse me. As I mentioned already, I think labor force is key to thinking about what's going to happen on the monetary policy side. So the absolute best scenario for the Fed would be for these millions of people that we would have expected to be in the labor force pre-COVID, for them to come back into the labor force. That would provide a lot of additional slack in the labor market and prevent wage inflation and prevent the chances of out of control wage price spiral. So the fact that we have seen, just this last month, a big uptick in labor force participation, or excuse me, in the labor force number is a really encouraging sign. That's going to make the Fed happy if it continues. But the thing to remember is that this number comes from a relatively small survey of households, and there's a large margin of error there. So these numbers tend to bounce around more than the employment numbers that come from companies themselves from the establishment survey. So probably 1 month isn't going to be too reassuring to the Fed. But if we saw several months of gains in the 500,000 range for labor force growth, that would be something that the Fed would look very kindly to and probably change their thinking about what they had to do in terms of near-term tightening. So now let's start digging in a little bit more to the Fed's conundrum. So if we look at what's happened to average hourly earnings, that's the blue line in this graph. They've been growing, at a very healthy clip for more than a year now. So historically, at least since the global financial crisis, we've seen average hourly earnings grow about 2%. And if we look over the last year, you can see it's been a number that's more like 5%. The current year-over-year number also a little more than 5%. This is something that really you can't sustain that sort of wage growth and also have a 2% inflation rate unless there's just huge gains in labor productivity, which in fact we haven't seen this year. We've seen the opposite. We've seen very low productivity. So the fact that wages are growing much more quickly than the inflation target for the Fed is a real challenge. The caveat to that is that we also have very high inflation. So while workers are earning a lot more, their purchasing power on an inflation adjusted basis is going down. But of course, what's going to happen if there's a labor shortage and there's high inflation, then workers are going to demand higher wages, and we'll see even higher increases in average hourly earnings. And that's the wage price spiral that everyone is very worried about. So what is the Fed going to have to do here? So The Fed is really, I would say, on the verge of losing its credibility as an inflation fighter, as an organization that puts a target inflation rate first. This is a real serious concern to folks at the Fed. There's an asymmetric risk that they face if they don't tighten enough, if they're not aggressive in their monetary stance. They're going to lose credibility with the markets, with consumers, and you're going to end up in a situation like we had in the early 80s, where the Fed was forced to really essentially run the economy into the ground in order to stop inflation. On the flip side, it's very hard to know what's going to happen over the next year, especially in an economy that's very different than any economy we've seen in the post-war period. So to make projections as to how the current tightening or the tightening to date is going to impact growth going forward is a tough call. Is it going to be enough to slow things down? We see some signs of slowing in things like the housing market, but overall, a report like today's report, where we're continuing to add 300,000 jobs to the economy, suggests that the Fed is going to have to get more aggressive. And I think they're going to err on the side of preserving their reputation as an inflation fighter. And so essentially, if they have to run the risk of overshooting, I think they're going to run that risk. I think they're going to continue tightening. I think what we heard last week from Chairman Powell and others on the Fed was that we're probably in for a recession, or at least a high probability of a recession, simply because the Fed, the monetary policy works with a lag. They've got to tighten things. They're going to err on the side of being conservative as inflation fighters. And so that's probably going to increase the risk of a recession versus a soft landing. And we're starting to see, in my opinion, dialogue coming out of the Fed that is preparing us for a recession versus a soft landing, versus the thread the needle Goldilocks scenario. And so I think it's going to be quite interesting to see, how the Fed responds to this. I think 75 basis points for the next increase in the Fed funds rate is very much in play. And I think if we continue to see very strong economic statistics, we'll see a continued ramp up to a Fed funds rate that's 4% or higher. If we look at what the market thinks is going to happen, I'm going to skip over this. If we look at what the market thinks is going to happen to the Fed funds rate, this is a graph that shows essentially expected Fed funds rate using the futures market. You can see that the market, this is data from a week ago and a couple days ago. So let's look at the orange line first. So that's essentially what the market thinks the Fed funds rate is going to be going forward. You can see that they see an increase in the Fed funds rate up to close to 4%, a peak in April of next year, and after that, a declining Fed funds rate. So I would interpret that as the market also believing that the Fed could potentially overshoot, in the sense that they will continue to raise rates very aggressively until the first part of next year, in which case perhaps the economy softens to the point that they can ease a little bit. But even going out through 2024, the market is still expecting a Fed funds rate of close to 3.5%. And that's up quite a bit from the previous week, since before Jay Powell's speech in Jackson Hole, there was an increase of about 10 basis points just immediately after that talk. That didn't necessarily change the outlook for whether the Fed was going to overshoot or not. It just, I think, raised expectations of what the Fed would need to do in order to bring inflation under control. So with that, I think kind of to put it in a nutshell, I think there's a very big risk that the Fed is going to overshoot. I think that this is something they think about very carefully, because a lot of monetary policy is reputation and credibility. And right now, the Fed's credibility is on the line. So if they're going to err one side or the other, they're going to err on the side of inflation fighting. So one other thing before we open it up to questions, as we've been talking about for a few months, the Kenan Institute is undertaking a project to try to look at more granular economic growth around the country. So we spent this summer pulling together quite a bit of data on regional economic growth, trying to map things at the county level that can then be aggregated up to cities and broader metropolitan areas, and trying to understand on a more real-time basis what's happening in different parts of the country. So this is just a teaser for a larger release that we're going to do next month, where we're going to have regional forecasts for GDP for 2022. And but to give you a flavor of what we're trying to do, so here we're just looking at the 50 largest combined statistical areas. This is a census definition for sort of large, important economic areas, mostly around cities, large cities. And you can see that here the green, the darkest green shows employment growth to date in 2022. It's as high as 6.5% in some cities. So for example, out in the Bay Area. Or as low as 0.5%. So especially if you look at Ohio, for example, quite low employment growth rates. So while we've seen a very strong overall employment picture in the US, there's a lot of variation within the US, even within major cities. And if we look at, say, the top 10 list, you can see that there are certainly cities like Orlando and Raleigh, Durham, and Bay Area, where there's sort of fairly obvious stories about what's happening. But there's also some where maybe less obvious what's happening. So for example, in Las Vegas, it's less clear what's driving economic growth there. So part of the goal of this project is to really understand better what's happening in cities where, for example, Raleigh, Durham, here we're seeing a huge influx of tech workers versus Las Vegas, where it's less obvious what the story is. Probably the restart of tourism around the gaming industry. If we look at even a broader set of CSAs, so think of these as mid-sized cities, you can also see that there's a huge range of growth rates. So as high as almost 10%. So if you're looking, for example, Colorado, some of the Western Colorado areas have employment growth as high as 10%, to in some cases even negative job growth. For example, if we look in Wisconsin. So again, this is just a teaser for now, but as we move forward with this project, we're looking forward to providing folks with much more insightful information about what's happening at the city and state level. So with that, I'm going to stop sharing and open it up for questions.
Thank you so much, Greg, for those insights and your analysis of this month's report, as well as your teaser of what's to come for next month. You're helping me mark it, so I appreciate you providing that for folks here. Please stay tuned for Press on the Call. We will be sharing more details ahead of our October release, so please stay tuned for more if that map and those preliminary rankings interest you. So we've got a few questions to get things kicked off. As a reminder to folks joining us here on the Zoom, you're welcome to submit your questions using that Q&A function at the bottom of your screen. If you are joining us by phone, you're welcome to email your questions to me. Again, I'm at Mackenzie_Babb@Kenan-Flagler.unc.edu. Our first question comes from Jason Parker at WRAL TechWire. What might we expect to see with regard to the local labor markets in the Triangle region of North Carolina, as well as statewide?
Yeah, so I mean, what's happening in labor markets here in North Carolina, I think is pretty interesting. Obviously, there's been huge increase in employment in the Triangle area. You saw from the list that I just put up that the Raleigh-Durham area is one of the fastest growing in terms of employment growth to date. I think we expect this to continue. I think anybody that's been looking for a house or an apartment in the area realizes that there's just a huge amount of new demand in people moving here and creating new demand in the Triangle. It's starting to feel like there's a critical mass that's been reached, especially in terms of the tech space here in the Triangle, and that feeds on itself. We certainly see that in some other high growth cities. Austin's the one that comes to mind. I did my graduate work in Austin in the 90s, and and what's happening in the Triangle right now feels so much like what was happening to Austin in the 90s, in the sense that you just saw massive growth and in migration. And I think that's probably going to be the largest source of labor market growth in the Triangle now. The labor markets here are extremely tight. Of course, we bring students into the major universities here and create new supply that way. But I mean, if you take all the graduates from all the universities in the Triangle, you're still just looking at, I don't know, maybe 10,000 jobs. I expect we'll probably grow, a factor of 5 to 10 more than that per year. So that means people moving into the area. It's a very dynamic labor market around here for sure. Anyone that's trying to hire like we are knows how challenging it is to recruit folks.
No doubt about that. There was a follow-up submitted by Jason as well. What concerns, if any, should folks have about a growing number of large corporations backing out of promises to invest and create jobs in North Carolina? Can you respond to that?
Yeah, I don't feel like there's anything systematic there. I think when we look at the kind of net increases versus number of jobs or amount of investment where people are backing off, it doesn't feel like there's been a huge reversal if there's something systematic about it. I think you can tell a story about what's happening in particular industries or particular companies. It doesn't feel like, for example, what we saw around HB2, where there was some real concern that a decent number of businesses were having, and you could put a finger on what the problem was. So I'm not concerned about it. And frankly, if you're a company that's already here, or maybe even a company that's keeping your commitment to come here, having less competition in the labor market, you might perceive as a good thing.
Absolutely. Thank you, Professor Brown. Our next question was submitted by Kay Khan. I hope I pronounced that correctly. Federal COVID emergency declaration is noted will end this October. What effect might this have on labor for the financial market?
Yeah, I don't know. That's a good question. I'm not exactly sure, what we would expect to happen. It feels like all effects related to COVID are now fading pretty rapidly. There's still some tail there. We still see, maybe 500,000 people or so who say they are not in the labor market because of COVID-related reasons. That could be long COVID. It could be caring for people that have long COVID. So, but again, that's a pretty small number when you look at the overall size of the labor force. So I don't see that there's going to be any kind of huge impact from COVID in any part of the economy, unless we have a new variant that really causes a lot of outbreaks, a lot of illness, and we kind of go back to a situation like last winter, where it's a top of the mind type issue. So I think things phasing out, things fading away, whether they're federal programs, whether they're corporate policies, whether it's people's own reluctance to undertake certain types of economic activity, I think those are pretty rapidly moving into the past.
Fingers crossed on that for sure. No more variants is my mantra for this year. Our next question comes from Rob Schofield at NC Policy Watch. We know inflation is a global issue. Doesn't that limit the Fed's ability to influence it?
Yeah, absolutely. That's another part of the conundrum for the Fed, is that it isn't like the U.S. is an outlier on the inflation side. In fact, Europe is worse, largely driven by energy prices on top of all the other things. But the differential there is that their energy costs have gone up more than ours, obviously, because of the situation with Russia and Ukraine. So yeah, the Fed is going to be limited in its ability to do that. At the same time, I think if we had 6% core inflation and a 5 or 6% unemployment rate, there'd be less concern on the part of the Fed. But even without energy, kind of global drivers, supply chain, energy type stuff, the U.S. economy is super hot. And I've made the case, over this year, that the U.S. economy has never been hotter, in the sense that it's never been farther above its potential output level than it is currently. There's just so many economic indicators that are sort of at records or close to records in a sense. So the Fed, I think, even with these other external pressures, they can't control that much. Still need to get a handle on what they can control, which is an overheated labor market.
Great, thank you. Our next question was submitted by Bob Royce. I hope I'm getting that right. What effect is the aging population having on the labor pool?
Yeah, I mean, that's a really interesting one. We've been keeping an eye on labor force participation among 55 and older. That's a group that is somewhat distinct in that they're kind of close to retirement, but not at retirement. There was a huge drop off in labor force participation for 55 and older at the pandemic. And the question was, okay, are these people going to come back? And so far, the answer seems to be no, right? That, there's some anecdotal evidence of people unretiring, right? Especially when the market was down, quite a bit. There was people thinking that maybe they needed to work longer. But overall, there's been a sustained decline in terms of participation by workers 55 and older. That's a big chunk of the kind of missing labor pool in the US.
Great, thank you so much. Our next question was submitted by Peter Pignataro. As always, hope I got that right, who asks whether will affordable workforce housing slow the business expansion in red hot areas such as Southeast Florida? And Peter, while Professor Brown formulates an answer, I would say please stay tuned for our drop next month of the project that Greg was teasing, because I think this will start to speak to this question and more. But Professor Brown, would you like to take a stab at that?
Yeah, I mean, affordable housing is a big issue for places that have grown. I mean, there's been so much differential growth, as I showed in the regional graph. There's some areas that are just growing gangbusters, and other places that are basically stagnant. And as you would imagine, the places that are growing gangbusters, it's very, very difficult to find affordable housing. So that is going to limit ability to hire, because if people can't afford to live there, they're not going to be in that labor pool. So how do companies fix that? I mean, maybe they're going to have to be more flexible in terms of work from home or work from anywhere type of policies. The housing issue is a huge issue, and I'll plug our real estate center here at Kenan-Flagler. We're doing a conference on affordable housing and workforce housing later this year. So would certainly welcome you to join that. But it's a huge issue. The economics of how you create affordable housing, it's difficult, especially in the current environment. There's all kinds of institutional constraints around it. And when you have cities that are very hot, you literally just can't build stuff fast enough, even without those constraints that are institutional constraints. You just can't build housing fast enough. So I think it is a dynamic market right now, and especially as we see differential growth across different cities, it's hard to know how it's going to shake out. But I'm currently sitting in Colorado, where it's almost impossible to find a house if you want to buy a house. So Raleigh-Durham's the same way. Certainly parts of Florida are the same way. One remedy that we've seen on the West Coast is people moving out. Right. So people are moving to other cities that are more affordable, and companies figuring out how to manage that.
Yes, unfortunately, your moderator was unable to find housing in Colorado. That's why I'm coming to you from Raleigh. Professor Brown, we've got a number of questions. I'm going to ask you to do a bit of a lightning round with a couple of these. Barbara Senich notes that it seems the service model for hospitality has changed fundamentally due both to green policies and staffing issues, kind of noting the reduction in maid servicing in hotels, airlines, requesting that you check your own bag, printing your own tags. There would seem to be no reason for these companies to revert to prior models. Do you think this will have a permanent impact on the number and types of people employed in the hospitality industry, short of sector growth, obviously, she notes?
Yeah, so this is more of a personal opinion than a professional opinion on it, because I don't know a lot about that industry in particular. I think it's out of necessity right now because they just literally can't staff positions. I don't think customers are happy about it. So I think they'll have to be either an improvement on the current model or reverting back to the previous model.
Great, thank you. And this will be, I believe, the last one we'll have time for, but we'll see how quickly we can get an answer. Stephanie Neiman says, can you share any labor market trends and 2023 expectations for knowledge workers versus lower scale or blue collar hourly workers?
Yeah, I mean, I would expect that going through next year, there's going to be demand across the spectrum for all, low, medium, high skilled workers. Longer term, I think the prospects for high skilled workers are going to be quite strong, just because we were seeing so much growth there. I expect that growth to continue. I think demand for low and mid skill workers is really going to depend on how the supply chain issues shake out. If companies are serious about onshoring stuff, it's going to be a very strong market for people in manufacturing, transportation, other industries. If people revert back to pre-COVID, outsourced production, then probably not as strong a job market for them.
Great. Thank you so much, Professor Brown. I know that we are just over time, and I know that we didn't get a chance to respond to all of the questions that were posed. So I just want to invite you, if you're interested in continuing the conversation or having those questions answered, please do reach out to us. You can reach out to me. Again, my email address is mackenzie_bath@kenan-flagler.unc.edu. My contact information, Professor Brown's contact information, and more about our suite of experts are available on our website at Kenan-Institute.unc.edu. So please visit us there as well. We would be happy to support your coverage on this and other business and economic issues. So definitely check us out, see how we can plug in. Always happy to help. And of course, please save the date. We will be gathering again for next month's jobs report. That'll be held Friday, October 7th, again at 9 a.m. Eastern time. So please mark your calendars. We hope to see you then. Thank you again for joining us today, and we hope to see you again next month. Until then, take care.